Good morning, everybody. We're going to get started. More people are just continuing to log on, but we're going to let them just hop in while they get here. So thank you, everybody, for logging on this morning. For those of you that don't know me, I am Spencer. I'm the team's administrative coordinator. And we wanted to start off by welcoming everybody to our second virtual investors meetup this morning. We're really excited to be hosting this class this morning, and I think even more excited for our special guest speaker that we have this morning. We have been working for a very long time now to introduce our clients to Greybrook, and we are very happy that it is finally happening this morning. We're also always very humbled by the overwhelming response we get when we host events like this, and this morning is no different. We have a great turnout as the number keeps going up. People continue to log on here this morning, so we just wanted to start off by thanking everybody for joining us here this morning. As many of you know, advising in real estate investment is something that makes up a fairly large portion of our practice. We have been working with investors and speaking to a similar forum for many years now. So again, we're just always very excited to host a class like this. We have a ton of great content to get to this morning, but first I wanted to quickly just introduce our team to everybody, all of our sales partners, for those of you who haven't had a chance to meet the entire team. So I'm going to start off with our sales partner, Shauna Connolly.
Hi, everyone. My name is Shauna. I'm a sales partner here at the Heddle Group. Thank you for joining us this morning, and hopefully you guys find some great value in what we have to talk about.
Thank you, Shauna. Next, I'm going to introduce our sales partner, Nicole Lanigan.
Hello. Thank you for joining us to our Virtual Investors class, and I hope you enjoy.
Thank you, Nicole. Our sales partner, Sue Aiken.
Morning, everybody. Glad you could all join in. Lots of familiar faces and names there. Lots of good stuff to learn and listen to today, so enjoy.
Thank you, Sue. And last but not least, we have our team leader, Mike Heddle.
Good morning, everyone. You're all used to seeing me, so I'll give you an update in a moment. I think Spencer's going to share a few other things, but it's great to have these numbers. I'll share some of those numbers just with you all. I think we had about 105 people registered, and the participation is fantastic. So thank you, everyone, for taking a bit of time this morning.
Thank you, Mike. So Mike is going to get things started in just a moment. I'm going to go over an agenda for this morning. But first, we actually wanted to share some exciting things that have been happening with the team recently. Some of you are aware that we recently moved our office space. We renovated a space here at the Royal LePage office in Hamilton on Rymel Road. So we have been working hard the past couple of weeks to put the final finishing touches on our space, and we're really happy with how it turned out. We recently, actually, to tie into that, took advantage of our beautiful new space, and we filmed our promotional content for our partnership with Scott McGillivray. We are the trusted agent for the Scott McGillivray Trusted Agent Program for the Hamilton and St. Catherine area. So last week we had some camera crews in the space here, and we all had our big acting debut, if you will. So we're very excited to share some of that content with you in the next little bit. Yeah, so keep your eyes posted for that. We'll be sharing that hopefully soon. And I guess that's it in terms of exciting things that are going on with us recently. Okay, in terms of our rundown for this morning, Mike is going to take over in just a second, and he's going to give us a Hamilton market update. He's going to talk about the Hamilton market conditions and what are driving them. And then after that, we can't stress enough how excited we are for our special guest and guest speaker. Darcy McConvey is going to be joining us from Greybrook Realty Partners, and he has a wonderful opportunity with Greybrook. And then after that, we have, he's one of our clients. He's one of our strategic partners, and I think more importantly, he's one of our friends. Andre Matos is going to be sharing a little bit of his experiences with Greybrook. And then after that, Mike is going to wrap everything up for us. So I think I covered everything that I wanted to. Without further ado, I'm going to pass things over to Mike.
Thank you, Spencer. So it's great to see. I wish we could see faces. As Spencer mentioned, we've been doing this almost for a decade now, getting in front of some of our clients and investors. And if a decade ago you told me I'd be speaking to groups of people, I'd probably tell you there's no way. Don't put me in front of everyone. I'd rather stand in the background and observe. So, but this is a great forum. We're learning how to work and navigate through this virtual world. So bear with us, but I hope you guys enjoy. I'd like to start by just kind of getting some participation. I've put a question here. Sorry, bear with me. It looks like we're having some challenges there. I've created a poll, and I don't know if you guys can see that, but if I could get a bit of participation here. How many of you plan on purchasing a property or an investment property in the next 0 to 3 months, 3 to 6 months, 6 to 12 months, 12 or more months, or the last, I thought this is kind of ties into this month's summit. You never want to buy a property. You'd rather invest passively. So for those of you that are really just interested to hear what Greybook is going to be presenting, we're really excited about. So I'll let those poll results kind of come in. Thank you everyone for participating. I'm watching your numbers come in here. Great participation. That's awesome. I'm going to share these results. So pretty good participation. We did this last time and we saw similar numbers. So, roughly a quarter of you are active in the market looking to buy properties, within the next 3 months. And that's actually spread out quite evenly, roughly a quarter in the next 3 to 6 months, and then roughly a quarter afterwards. So it's great to see that we've got a room of action takers. And it amazes me. We've always found that with our network and with our clients. Many of you are action takers, which is fantastic. 2020, wow, what a year so far. I used a slide similar back in the spring for those of you that attended, but it's certainly been unprecedented, and that terminology is definitely overused, but I don't know what else to kind of articulate, what word to articulate, what a strange year. We've seen not only a global pandemic, but we've seen the effects on the small businesses, how they've had to learn to struggle with social distancing measures and closures. We've acknowledged real life heroes in our communities, including frontline workers such as nurses, teachers, and grocery store workers, truck drivers, and many, many more. And we're grateful for that. We've witnessed a decentralized political and social movement advocating for nonviolent civil disobedience and protest against incidents of police brutality and racially motivated violence in the US, which is an amazing movement to witness. And most recently, I'm sure we were all on the edge of our seat for a couple of days as we watched and witnessed a historical US election that, amongst many positive changes, embraces the first woman, the first Asian American, and the first Black American to be elected as vice president. And as a father of 2 daughters, that's something that's very, very cool to observe and to witness. So I know that we live in an era that we're just bombarded and inundated with all of this news and these tickers and symbols and signs and headlines everywhere that we look. And I'm going to begin. I've shared this story once, but it was too cute not to share again. I'm going to share how COVID has impacted my family back in the summertime. Certainly when we saw some closures, we got to spend a little bit more time as a family. And one afternoon, we all went out for an ice cream cone. And as we came back, my youngest daughter, who you can see here, pointed to my dashboard and she said to me, Daddy, what does that symbol mean? And I've got all these symbols on my dashboard, and I was confused what she was referencing to. So what I said to her, which symbol are you talking about, sweetheart? To which she clearly pointed out the one of the man flying through the air trying to bonk his head on the cell phone. And we all burst into laughter. I don't know that I'll ever look at a USB connection symbol again. But the point behind this cute story is it's confusing. All of these symbols and signs and media and tickers, they're confusing out there to all of us, whether you're 6 or 16 or 66 or 96, we're inundated with information. And our goal here today is to bring you the real information. I like starting with the slide similar to this. This always amazes me. Whether we host this event in the spring or the summer or the fall or the winter, I can always find an article that illustrates my point. Last week, the Financial Post reported on November 4th that the Canadian real estate landscape is shaken to its core with downtown Toronto sales falling. And only 3 days later, the same institution, the Financial Post, indicates that the Canadian real estate market is on the rise with heavy Sorry, I can't quite see all of that. Heavy interpretation or participation in certain parts of the country. I've got a bit of that blocked out, so bear with me. But the point is, the information we're given by all of these sources of media or outlet or social media are very confusing. So I'm going to dive into what's happening here in Hamilton. That's what some of you have logged in to see. And we continue to see what we're calling a strong market. The October stats are out. They just came out last week. Listings are in fact lower, almost 40% lower, which means we're putting fewer homes on the market for sale. There's lower inventory than we saw in 2019. Roughly 40% lower, but sales have increased. We've seen 1,600 sales, which represents about a 24% increase over last October. So although there are fewer homes to purchase, we're seeing more people buy homes. And this number is amazing to me. We see an average increase of almost 20% as we look at kind of the overall board. Our board reports on a pretty large geographical area, including you really from Burlington around to Grimsby. So a lot of numbers fall into this. You can see this chart here. You know, Burlington, as you look at those numbers, you know, Burlington's almost up 100,000 in average price year over year. You know, the same with Haldimand County and Hamilton and Niagara. So we see average price up really throughout the region over the last year, despite being in this interesting global pandemic. I always like to show our biggest movers. I find this kind of an interesting slide, and some of it depends on volume, and I'm not going to dive into it too much, but we see some average prices, like look on the right there, Flamborough up 48% in average price, Smithville, you know, 33%, Hagersville, again, 30%, Dunnville. It's interesting as I look at these geographical regions, we're seeing our biggest movers tending to be the outlier communities, which, you know, I guess it depends on how you want to interpret, could be a byproduct of COVID and urban sprawl. So it's great to see those outlier communities seeing a real increase in price. And again, just to dive into these numbers a little bit more, you know, fine-tuned, what's happening this year. Last year, we saw about 1,300 sales with about 2,300 active listings. Average price was about $545. I'm just looking at the Hamilton stats now. And this year we've seen a large increase really across all metrics there. You know, sales are up 23%. Listings we talked about are down. The months of inventory is a really interesting metric, which I'm going to talk about. Average price up 20%. And then the days on market, we're down. We're only at about 18 days to sell a property right now. So the market's hot. I'm asked this question almost every day when I'm in the public. How's the market? To which my reply is, what market are we talking about? Are we talking the luxury home market? Or are we talking about the condominium market? We can even break down into smaller nuances like bungalows or property classes. And what most people don't realize when they ask this question, they're asking, how strong is the market? And that's the market intelligence tool that I like to use, as either referred to as absorption rate or months of inventory. And you can see over last year, we're now down below 1 month of inventory. And I'm going to explain that a little bit. It's a straightforward calculation. We just divide the active listings divided by the number of sales. And that tells us how long it's going to take to absorb or sell all of the inventory in the market. And last year, we were sitting at 1.8 months. And this year, we're sitting at 0.9 months of inventory. So the lower that number, the stronger the absorption rate is, or the stronger the market is. And this is a great graph that just really illustrates, we started analyzing this data back in 2017, but let me just define, when you're asking that question to your real estate broker or your mortgage broker, you know, ask the question, are we in a seller's market? Are we in a balanced market? Or are we in a buyer's market? Because those are really the tools that tell us how strong the market is. And if we're anywhere between 0 and 4 months of inventory, that's identified as a seller's market. You can see that in the red banner there along the bottom. The lower that number, the stronger the market. Anything between 4 to 6 months of inventory is identified as a balanced market. And anything over 6 months of inventory is a buyer's marketplace. So look at what happened over the last, let's call it 3 years here. January 2017, we started watching this metric. And at that time, for those of you that were investing or even in the market, you'll recall that the market was out of control. It was often referred to as a runaway train. We were hovering below 1 month of inventory at about 0.7 months of inventory. And at that time, the government started to put in some measures to cool this runaway train, such as the Fair Housing Plan that was introduced in April of 17, followed by the stress test in about October. of that year. And you can see how that started to soften the market, meaning we moved towards a balanced market. But because we're in such a unique area, which I'm going to talk about, these fiscal policies that the government was putting in place, didn't really have too much of an impact as we continue to have time take over. And we saw that line trend downward, really till you see the next red line, which I've identified the state of emergency back in April when we hit COVID. We were starting to drop down to, again, 1 month of inventory. As COVID hit, we saw the market soften. But look at that, after only 2 months, pardon me, we're now hovering around under 1 month of inventory. So it is a very strong seller's market. So when you're asking that question, I don't want any of you asking me, how is the market? So generally, ask me, are we in a seller's market or are we in a buyer's market? And I like to break this down. Many of our investor clients are aware of this. We can break this number down into submarkets. So for example, this is our Hamilton Central District. As a general rule, we see it hovering again around 1 month of inventory. But you can see the graph on the lower portion of the screen there. There are some markets that have hovered into a balanced market. Now, if you're an investor or a buyer looking to pick up a property, where do you think you may be able to negotiate a good price? In a strong seller's market, or in a balanced or even a buyer's market. So when we're working with clients that are looking to invest in real estate, we will dive down and peel the layers of that onion so that we can really determine what neighborhoods, what areas may be good opportunities. You can see this is Hamilton East. Look at the volatility there. One segment of that market, is swayed into a great buyer's market. So that would be a great area to potentially negotiate, not pay over asking price or not get into a bidding war. So these are some of the metrics and some of the tools that we'll look at when we're advising clients as they're looking to buy rental properties. And some of you are well aware of that. I like to show this slide because this is an interesting tool that we've never had access to until COVID presented itself. In real estate, we typically report on the lagging measures. So the information I just showed you or shared with you was statistical information that was reported based on last month's data. And that's a great tool. In fact, that's usually the only metric that we've got to forecast where the market's moving. One of our big booking systems has made this public to realtors, which is Showing Time. They're a software that handles all the showing bookings for most brokerages or big brokerages. And when COVID took place, they started to share this information, this data. And I'm going to just bring your attention to the orange line there in that data. You can see right around the state of emergency, which was March 15th, we saw an immediate decline on showing participation, the number of showings that took place on properties that were listed. And that makes sense. We were, collapsed. We were told to social distance. Open houses stopped taking place. People stopped wanting to go see homes. But it didn't take very long. In fact, it was by the end of May, we crossed back over that threshold whereby we were seeing more showing participation take place on showings, property listings, than we saw the year prior, which is the blue line. The blue line represents the 2019 average. So this is interesting, and this is something that we often watch if we're trying to predict what may be happening in the markets to come. It certainly starts with a showing. Our sales process starts with a buyer showing a property and then entering into an offer and then hopefully procuring an offer. And this is a great tool that we try to watch weekly just to kind of see what's happening in terms of participation. And you can see over the last month or two, there's been kind of some peaks and valleys in that activity. And I think that's coupled with weather and some uncertainty that we're hearing and reading in the market. But the takeaway you should be taking from here is we're still seeing more showing activity on fewer property listings this year than we did last year. So that illustrates some confidence in the market. And what's causing all of this? Why in a pandemic are we experiencing such a strong seller's market? And I think there's a couple of things. One of them is the region that we're in. We're going to talk about, the government introducing some regulations. So we've got these push and pull forces, and I'm sure Darcy's going to talk a little bit about the unique region that we live in his presentation. But there's really 7 main forces that impact real estate values. And they're things like migration, whether we've got positive or negative migration. Average income, is it on the rise or is it on the fall? You know, employment rates, mortgage rates. Andre's going to talk a little bit about that. You know, the ripple effect. So when we see people moving out of big epicenters like Toronto, which we're certainly experiencing, and then the effects of transportation. And for those of you that haven't shopped for a mortgage lately, this number is going to just amaze you. You know, we're seeing, and I shouldn't be posting this, but through some discussions, speak to your mortgage broker, but we're hearing rates of about 1.69%. 1.69% for 5-year fixed, as low as. So depending on you know, your history, your credit history, your employment, et cetera, but to borrow at this sort of price is really unprecedented. We haven't seen lending rates this low. And the last thing I'm going to kind of talk upon or touch upon here and talk about is really one of the big drivers as to why real estate values in this region have been so strong and continue to be strong, and likely will continue to be strong, you know, as we move into the future. And this document comes from what's called a municipal comprehensive review. So each municipality under the Places to Grow Act needs to assess and determine how they're going to grow, you know, with population growth and with economic growth. And although this report isn't in real time with COVID, and certainly we've seen some slowdowns on immigration, we're hearing our long-term immigration plan is still to allow, you know, when we get back to opening things up, you know, 300,000 to 400,000 new immigrants annually. So this region that we live in is very unique. The Golden Horseshoe is home to 9 million people today. It attracts 1 in 3 new immigrants and is forecasted by the year of 2041 to have a population of 13.5 million people. That's amazing. We're going to see almost half of our current population move into this area over the next 20 or so years. This region is Canada's economic engine. It produces roughly 1/3 of the country's GDP, and it employs roughly 1/3 of Ontario's GDP and 1/4 of all of Canada's GDP. So it really is a very unique region, and part of what makes it so unique is that we're landlocked. We've got Lake Ontario to the south of us, and the world's largest greenbelt around to the north of us. So you've got a driver, the economic engine really behind the province and the country, that is just running out of land. And I've shown this, but it's worth showing again because repetition is the mother of all skill. This is what's happened with density charts over 2005. As they put this report out, you can see the gray area indicates density. And 2017 was the last time that they put out this municipal comprehensive review. You can see how urban sprawl and density is continuing to fill in. And one group went as far as to predict what density might look like by the year 2041. And you can see we've really filled in all areas within that Golden Horseshoe area. So I wanted to kind of bring you up to speed. I'm going to just ask if there are any questions right now as to what's going on. If anybody does have any questions, I believe you can type them in the question bar. Spencer, maybe you can just kind of watch for those and read them aloud if you do hear any questions, or if anybody has any questions, I'd be happy to answer them.
I don't see any, no.
It's pretty typical. So I'm going to, before I pass it over to Spencer, actually, I'd just like to share, why we're so excited, to have Greybrook Realty Partners and Darcy here today. I guess my experience is I met Peter and Sasha almost a decade ago. We belong to a very similar, what's referred to as Canada's largest investment network, that typically elite members pay tens of thousands of dollars to belong to this network, to get access to, groups like, investment-focused realtors like yourself, or companies such as Greybrook. And when I heard Peter speaking on stage, I'd never heard of any sort of investment vehicle in real estate like this. And I was really blown away by it. And at that point, I started saying to them, let me get you in front of some of my clients. I think this is a great vehicle to invest passively. And Darcy's going to talk about all of those reasons as to why. So it's taken me at least, Darcy, we've been talking about this for about 5 years now. I've been poking you and probing and begging, and finally you guys gave in. So we're really excited because in my opinion, I know clients that have invested. I've personally invested. They are best in class when it comes to, processes, the partnerships that they create. They're a very reputable organization, and this is really something special for us to be sharing with you guys this month. So I'm going to hand it over to Spencer to make something a little bit more formal. But Darcy, thank you for your time. We're extremely excited, and I'm looking forward to seeing what you have to share.
Thanks for having me.
Thank you, Mike. So I have just a little bit of a bio for Darcy. I'm actually going to read it. I didn't get a chance to memorize it, and there's too much good stuff in here. I don't want to mess anything up. So Darcy is a director in Greybook's private capital markets group with over 8 years of management and private equity experience. He's a highly experienced advisor, personally managing many of Greybook's longest standing relationships by providing real estate development advisory services for many wealthy Canadian and international individuals and families. He works closely with clients to collaboratively create investment portfolios based on unique needs, suitability, and investment priorities. Darcy also leads a team responsible for developing and managing Greybook's strategic partnerships. Prior to Greybook, Darcy worked in investment banking at the Bank of Montreal and co-founded and monetized a successful sports recruiting and travel company. Darcy holds a degree in financial economics from Bowling Green State University and an MBA from London Business School. Darcy is a registered dealing representative of Greybook Security Inc., an exempt dealer. So, Darcy?
Thank you.
Darcy,
I'm
just going to hand that over to you, and I apologize. I'm just going to hand some stuff over to you here.
Sometimes those intros make you feel a little awkward, Can you hear me?
Yes.
All right, great. Yeah, so thanks so much for having me. Before I start, Mike, we've been we see each other a couple times a year, but knowing you and the Heddle Group and what you guys do, I think your clients are with as good as it gets in terms of a group when it comes to understanding the real estate market, putting in the work, being diligent, and really giving quality advice to people. So, obviously we're very happy to be here today, or I'm very happy to be here today. And kudos to you guys in your group, because it's, to have this many people show up to a presentation for educational purposes is pretty cool. So awesome. I would say for the, let me just grab this screen here. So before I jump into it, I'm having a hard time going full screen. There we go. Before I jump into the presentation, a quick overview would be, give an overview of Greybrook. I think we have about 30 minutes. And so I'll not rush through things, but there's a lot here in terms of how we work and what we do. So a quick overview, and then we'll go into a live investment offering that we have right now in Toronto. And then we will, if there's time, take questions from there. But you can always follow up with us hereafter, either with Mike, or you can reach us at invest@greybrook.com. So, as I was thinking about the presentation, there's obviously a lot being said around moving to sort of the peripheral markets. And look, we invest in low rise and sort of, ground-based housing from Hamilton to Cambridge, all the way across to Durham region. And so we sort of capture that greater Golden Horseshoe quite a bit. And then sort of the other half of what we do is invest in high density, high rise, sort of core Toronto, like Shepherd Avenue South, for those familiar with Toronto. So we kind of are both sides of the barbell, low rise and high rise. And certainly with a lot of our projects, we've seen a lot of buyer interest in the low rise market for all the reasons that you would have mentioned in your presentation, Mike. And I think the COVID effect is real for a lot of people, sort of moving away from the city, getting out of density. My sister's a great example, actually. She had a beautiful home on the Humber in Etobicoke, on the Humber River in a place called Babby Point, and has moved to Collingwood. So there's an interesting example. But on the flip side of it, you hear a lot of, particularly tech firms like, Shopify, Facebook, Google, saying, their employees can work from home digitally forever, or it's sort of an indefinite period. and which is great. But I think for the employees, sometimes, over time, what does that do? That ultimately opens up the global pool of talent, right? So if I'm a person that's working virtually, now I can find, and all of a sudden my competitive, the competitive pool goes global. They may be able to find someone as talented elsewhere for cheaper. So I think the tech firms are pretty smart, and they realize that, particularly when it comes to cross-team, cross-functional collaboration, very difficult to do from a tech perspective. So here I pulled up a couple interesting articles. One is the Amazon, Google, Facebook, and Apple are massive buyers or leasers of office space in New York right now. And so I know New York's not Toronto, but New York's an interesting place because it actually has net outflows in terms of population, whereas Toronto has in Canada has massive net inflows, right? And so New York, so you've got basically the four biggest tech firms either leasing or buying north of 1 million square feet in the heart of Manhattan during the pandemic. And so what does that signal to me? That signals that they know that core urban centers aren't dead for good. And that when this point in time passes, as severe as it is, and we don't know how long it's going to go, people are going to come back to office. Office might look a little different. There may be larger square footage per person, but people will come back to urban centers. So even though today it feels like it's done for good, that's just not the case. Here's another one talking about Facebook. And then I can send out a few of these links after, but one of the smartest real estate investors in the last decade is Brookfield CEO Bruce Flatt. And he basically is going contrarian to COVID, saying, they're going to double down on office. They're going to double down on urban centers, because if you look throughout history, urban centers have always been resilient and have always come back. So it's just an interesting, different perspective than most of us have, or at least what most of us are feeling today towards urban centers and high rise. So jump into our presentation. For those that don't know, Greybook. Greybook's a Toronto-based private equity firm. And so to get rid of the jargon, basically what we do is we have about 7,000 investors, and our investor base is quite eclectic. I call it eclectic. I think it's the right word for it. That ranges from dentists, doctors, and lawyers, entrepreneurs, up through to high net worth individuals, family offices, and institutions. And so what Greybook does is we partner with sort of best-in-class real estate developers, predominantly residential development. So 95% of our investment is in residential development. So we partner with best-in-class developers, names that you would know, and I'll show some of these names coming up. But like Tribute Communities, Fieldgate, out in your way, there's Lakeview, Empire, and a bunch of others in terms of sort of Southwest Ontario. And on a project-by-project basis, we're not a fund. We'll joint venture with these developer partners. Our Greybook and its investors will contribute the majority of the equity. So think about equity like a down payment on a house, where in a house you're putting 20% down. Greybook and its investors would be 80%, 85% of that equity. Our developer partner would be the difference, so call it 15 to 20% of that equity. And then from that point forward, it's our partner's responsibility to procure construction financing, execute a development through to completion. And then on the back end of a completed development, it's a profit sharing model. So we split profits, typically 45% of profits to the investors, 45% to the developer, and 10% to Greybook. So currently, we've made about 80 investments, and that includes completed and ongoing projects, which accounts for about 39 million square feet, about 27,000 residential units, and equates to about 17 billion in completion value. So ultimately, sort of the sellout value of a project. Let me see here. In total, we've invested about 1.2 billion in equity on behalf of our investor base and institutions globally. We, in all of our developments, and this is another interesting thing that we'll get into. I mentioned point in time earlier around, we're in COVID and people are sort of shying away from urban centers. But if you think about development, usually it's, call it 5 to 6 to 7 years in terms of the time from when you invest to the time you get your profit and you get your sort of return. If you think about COVID being today, and if you look out 2.5, 3 years, we don't know what that will look like, but I think it's a safe assumption that the city's going to be, hustling and bustling much more than it is today. In Toronto, for all the reasons you mentioned, is going to be a place people want to be. And so development is different than buying a unit today necessarily, in so much as you have to think about investing today for an outcome tomorrow. And that's the mindset that you should take. In all of our developments, we target sort of a double an investor's investment in 5 years or less, which would equate to a 20% annualized return. So this is our target metric that we're always looking for, and generally, we won't do a project unless it sort of meets that investment criteria. And then, these graphs at the bottom. So we manage sort of a diverse set of investments. Again, it's 80 projects over pretty wide span of geographies in real estate type and term. But one of the interesting things about what we do is development historically is a very difficult asset class to invest in. So if I wanted to invest in development, well, how would I do it? I would have to either be a developer myself, which I don't necessarily really want to do because it's very capital intensive, and the banks probably wouldn't lend to me like they would lend to a marquee developer, or start small and get big, or invest in a vehicle that allows you to access this massive asset class that has historically been privately controlled by call it 20 families in the city of Toronto, and is a very difficult asset class to access. So, that's really what Greybrook has effectively done, is we've provided an opportunity for people to access that asset class of real estate development in a very passive way. So I know the poll earlier said who wants to buy real estate and in what time period, 3 months, 6 months, 12 months, 12 plus, or invest passively. Like at the end of the day, you can do both. I think about myself. I'm busy enough that it'd be very difficult for me to have an investment property. But in doing that type of investing is not necessarily for everybody, same as passive. But one of the interesting things about Greybrook is you can invest either through a corporation, like a medical corporation. It's a very tax efficient structure, directly as an individual, or through a registered plan, like an RRSP TFSA. And if you believe in development as a general strategy, because you see high rises or you see home builders building homes, and obviously the manufacturing of real estate is a very lucrative thing, or can be if you do it right. If you believe in the strategy and you believe in the firm that you're investing with, ultimately I think what's neat is we can create a portfolio of real estate development opportunities, which could include a high-rise development, low-rise. It could be in Hamilton, core Toronto, Durham region, and we do invest quite heavily actually in the US as well. So now you can kind of create a portfolio within a development strategy, which is quite a unique thing to be able to do. So, in light of time, I'm gonna swing through some of this quite quickly. But our about 80% of our investments are Greater Golden Horseshoe. From sort of core Toronto out. You see Quebec, Montreal, Ottawa. Those investments are what's called value add, where we actually have a major institutional partner in the Bank of Montreal. That's predominantly our co-investor. And then we have a really interesting strategy called Society Living in South Florida, and we're taking it nationally with a very large US partner, which is modern apartments, very technology enabled, amenity rich, phenomenal programming, really catered to the millennial demographic that is higher propensity to rent than own, and creating a community and a lifestyle within a building. And it's a strategy that's done very well for us. So again, some of the highlights on our partners, like, exceptional roster of partners. We're not looking to tack on new partners. We love the partners we have. And, one of the key things about the partnership is that it's their responsibility to execute, one, to put up a balance sheet. And this is a very important thing. Most of these partners don't need our money or our investors' capital. And that's a common question that we get. But the reality is our model allows them to kind of keep the wheel running and keep the engine growing. In addition to, a lot of these developers own land that's developable 5, 10, 15, 20 years away from now. And so they need to free up their own equity to then develop those lands so that they're build ready. But yeah, it's their responsibility to put up the balance sheet, the guarantees, and to execute a project through to completion. But in the meantime, at Greybrook, we have about 70 employees. About a third of them are former developers themselves. And we actually co-manage all our projects start to finish. So, we look at sites to acquire alongside our developer partners. If we say yes, we then take it out to our investor base in sort of garner investor interest, close the project, and then we co-manage alongside our developer partners start to finish. So whether that's, talking with banks, architects, thinking through the site plan through to completion, we're in the weeds day to day and have a very deep and strong team to do that through to completion. And obviously the reason we do this is to protect our capital and our investor capital along the way. So that's sort of Greybrook in a nutshell. We're not just a financial partner, we're actually a real genuine development partner. And that's why we're not looking to just tack on new development, new, I say partner a lot, but new basically developers, because the ones we have are our genuine partners. So a little more about some of the current projects we have. On the left is a high-rise in Toronto at Ordnance, which is actually closing and paying out investors early next year. It's been a 7-year project. Storybrooke in the town of Fergus. The Way in Mississauga, which is with Sobara, which is stacked townhouses. And then you see on the bottom right, you see the Stockyards district, which is kind of like the Junction, Keele, and St. Clair area of Toronto, a project that has done extremely well and is about 94% sold and almost fully constructed. So I think we all get the population thing, but one of the interesting things, because Mike hit on it, we're expected to grow by 4.5 million people over the next 25 years. And on that point, what's fascinating is if you add 4.5 million people to the population, you need to be able to deliver the equivalent of 1 unit for every 2.5 people. So I think that number is 1.8 million residential units need to be delivered over that period of time. So as much as people say, wow, look at all the cranes that are in the ground, look how much is being developed. And I'm not saying anyone says that, I'm just saying generally. The reality is, to Mike's earlier point on the Greenbelt slide, which I have as well, is we have a real land shortage. We have a very difficult planning environment in Ontario, and we have demand that's ever increasing. And so one more interesting point that I wanted to bring up in terms of live articles, and these are all within the last, under a month, is that Trudeau came out last week or the week before. This is October 16th, I guess. So, a few weeks ago. And he basically said he wants to increase immigration during COVID. Not sure how that exactly is going to happen. But beyond that, he's upped our immigration targets by 15 to 20% on a per year basis. So we were already the fastest growing major municipality, maybe outside of Dallas-Fort Worth in North America. And now we're going to be the fastest growing. And so there's no market in North America that comes remotely close to what is happening in the GTA. And it's going to continue to happen. So again, having this point of time reference and mindset is very important. More about the Greenbelt, the legislation and restrictions around where you can develop creates ultimately a very limited amount of land that you can develop on. So about Greybrook generally, and then I'll jump into the investor presentation, is, we're very disciplined about our purchase price. We have proven partners that have, delivered thousands, if not tens of thousand units across major metropolitan areas historically. We maintain control over major decisions as a firm. So it's a 50-50 partnership. So we have veto rights or effectively we make all decisions together, and contractual agreements with investors to ultimately protect investors' downside and obligate the developer to take the, in most cases, the financial risk, where we're actively managing projects start to finish. So I'm going to jump into our current, how am I doing for time? Mike, I give everyone else heck for not staying on time, so I better stay on time.
You're doing okay. Keep going.
All right. So this is a kind of a current live offering, and that's a pretty quick summary of Greybrook. Again, we can go into a lot more detail as and where needed for people. So happy to have that conversation, even as a, be great to have you as an investor, but more so just to understand how this works. So we're always available, and we have quite a good team to deal with any queries. So this is our current, I teed up core urban areas conveniently, I guess, for a core urban project. Not to be funny, but this is obviously a great area, Yorkville, Toronto. So for those of you that know it, it's kind of the major transportation node and hub in Toronto. Bloor and Yonge, Avenue and Yonge, sort of a poshy type area where in quite a sought after node of the city. So this project we're doing with Tribute Communities, there's more on Tribute later, but I think we have 11 projects with Tribute that are either completed or at various stages. And so, phenomenal partner, been doing this for now, I think 2 generations, maybe 3, and we've had a lot of success with them. So here's an example of a project. So you can see on the right, it's the site total is that red box, which is right at the corner of Davenport and Avenue Road. So, really lovely corner. I love it. I drive by it every day. And it's definitely a marquee sort of hub in the city. So for this project, as you look at the offering, we're raising about 41 million in equity. Our minimum investment in any given project is $25,000. And again, that investment can be made through either a cash or a registered plan like a LIRA, RSP, TFSA, or through a corporation. We have most of our investors are domestic, but we have a number of foreign investors as well. And so it's a pretty flexible investment offering. The project term is 6.5 years, and there's reasons for that. And actually, this is kind of one of the points I wanted to make earlier, is that in development, if you're developing a high rise, whether it's in Toronto or Hamilton, these things take time. And really, time in development is your ally in most cases. It's very difficult to generate, significant returns in a short period of time if you're in development. And so if you're going to be honest with yourself, which we try to be very, very open and honest about our timelines, like this is the realistic period of time it would take to get through planning, construction, and through to completion, and still generate a very significant return for our investors. So the land area is about 21,000 square feet. The project, as we understand it today, is a gross floor area of 250,000 square feet. Part of that would be retail. And then you see here the number of condo units and the average size and the number of stories that the tower will ultimately be. So here's the site looking north to south. And if you look down Bay Street or Avenue Road, those are very popular corridors. There's a lot of sort of boutique, high-end, high-rise in this area. So we're very excited to get a site like this in Yorkville. It's not our first, and we'll get into that in a little bit. So here you can see the very top under the word site, our site location with the pin, and the connectivity to TTC, the connectivity to the rest of the city of Toronto, which is obviously very important. Again, our guys love to put and girls love to put images, which is great, but at some point we get the point. So remaining disciplined about our investment. We talked about Toronto, and you know what? There's a lot of people saying, well, you know, condo pricing is flat and or the rental market's down 20 or 30%. And they're right. And there's reasons for that. And again, this goes to our belief that the wave will come back. So if you looked at what happened, you know, end of 17 that Mike referenced when B20 went into play, the low-rise market totally stopped and the high-rise market boomed. These things are cyclical, right? And now you've got low interest rates. People are flooding back to the low-rise market, whether it's Markham, Durham region, you know, Halton region, because things have become more affordable and people want more space, and there's a number of other reasons. But we believe that in time, that market will stay strong. The core market will come back. And you know, when people left the low-rise market, they went high-rise. Now they left high-rise to an extent and have gone low-rise. The other thing about rents, you know, I could go down this path and I probably got to stay on track here, but is Toronto's the second most important market to Airbnb in North America. Airbnb has gone to zero in the core. So obviously that frees up a lot of vacancy. That will come back. It's a matter of, you know, can people sustain it to that point? Two is that many people that were renting, like this phenomena is very real. In fact, my assistant, a lady named Abira, is married. Her and her husband rented a place. Now they left and have gone to live with their parents until COVID is over, because they're saying, well, why would I rent if I can't leave the place, like, and no one's around? And so their full intention to come back. And probably 10 of my other investors have family members, adult children living at home with them until COVID is over. All those people will be back. So look, it's not great what's happening with rent today, but it's important to think about it in context. So here's the Yorkville submarket. Someone fire me a note if I'm running a little long. I've got 5 minutes. This is the Yorkville submarket. So on average, unsold inventory in Yorkville today is asking $2,231 a square foot. 93% sold. So by far the most premium submarket in the city. If you look at it as compared to sort of all the other major submarkets in the city of Toronto. Here's an example of the nodes and the different nodes that are emerging, and we'll get into these a little bit. So we're the star at Davenport and Avenue. You see the purple buildings being more high density and the yellow buildings being more boutique type offerings. So here's a breakdown of the various sites, and we don't need to go through them all, but it just says what has been built or is being built, the percentage sold of the units in these various projects, and how they're doing. So like, if you look, anything that's in sales is north of 80% sold, which is a very common phenomenon because you can't start building until you're sold 70 to 75% of all your units. So it's quite a tight market, actually. And then here's the more boutique buildings. So in general, these would be larger square foot, larger per square foot price, and sort of larger ticket. And who's buying these buildings? There's definitely foreign buyers, but actually there's a huge swath of people coming out of the Forest Hill area, the Rosedale area, Moore Park, these types of neighborhoods that have large homes that are high maintenance because they're old. They want to stay in this pocket and they want what they want, which is nice finishes and space, but they don't want the management headache. And so shockingly, there's quite a large number of people that are in that bucket. And these are why these projects have actually done so well to this date, to this point. So again, these are sort of views from what it will look like in the project, which is a great location. As Greybrook, we're the second largest landowner actually in Yorkville, behind First Capital, which is a Canadian publicly traded real estate company. So we have a lot of experience here. We really like the market. We've had a lot of success here historically and believe we'll have a bunch of success on this project we're launching today. So here's the project timeline. The planning portion of the project is about two and a half years, at which point we'll start sales. So again, we're not starting sales till mid 2023, which our belief again is that, the world will look different than it does today, more like it did. Some of the tools that are implemented during COVID will obviously stay. And this hybrid work mode, I think, will be a thing that's real. But we're not starting sales until 2023, at which point it's 4 years thereafter to sell, construct, and complete the project. Here's just some of our direct comparables in the market today. So if you look at, our very near neighbors with very similar product, what they're selling for today ranges between $1,750 a square foot to $2,500 a square foot in the 2020 market. And we're going to be selling in the 2023 market, 22, 23. And so we've underwrote this project ultimately, and I'm sort of ripping through this at about $2,000 a square foot, which is below where Yorkville is today. The average price for a high-rise new build in Toronto is north of $1,300 a square foot. That includes all pockets of the city. And so, we are, very confident that a lot of the King West, Liberty Village professional people that are in their, mid 30s, early, mid, late 30s are going to want to be in Yorkville, maybe not able to afford other buildings that are going to be at $3,000 a square foot, which is a crazy number to say, but want to get in this pocket. And this 2,000 number is very much in line with today, and we're not selling until tomorrow. So for every dollar that comes into the project, we're expecting $2.30 out. So if someone invested $100,000 in their RSP over a 6.5-year timeline, that we're projecting it to turn into $230. So one last quick note is, so capital contribution, Greybrook's 85% of the cap of the initial equity investment, our developers 15. So you see that on the structure to the left in the ownership structure. Investors are paid back and made whole first before there's any profit sharing, at which point investors share in 47.5% of all profits, the developer 45%, and Greybrook 7.5%. All of our projects are audited by sort of tier 1 audit firms. So in this case, it's Deloitte and MMP. And we report on all of our projects twice a year in terms of progress. A little more about Tribute. In final quick takeaways, why development? It's a very hard asset class to access ultimately. You're investing today for tomorrow. The Yorkville submarket, a very resilient buyer pool, much more than, you're talking about the top 15% of people generally in terms of net worth, quite resilient. And the price point is blended over a 6.5-year project, which is, so you have to separate yourself from today to an extent, even though I think pricing today is very competitive. And then finally, the core will come back. We're in a point of time. People are wired to collaborate and like sharing and being around people as tribes have emerged. And immigration is going to do nothing but continue the city to boom. So if you have a medium to long-term horizon, you're going to do quite well. Finally, Greybrook employees and management invest on the same terms as all of our investors. And so there's only one share class. We're all in it together in the same terms and conditions. So that's it for me. I think I was over time. If you want any other information, please do reach out. We love working with Mike. We love working with anyone who's interested in this type of strategy. We do have a ton of lawyers, doctors, dentists that are great investors. And so you can find us at invest@greybrook.com, and I will turn it over.
That's awesome. Thank you, Darcy. I'm going to take control back. I don't know if you can send that over to me. We had a few questions come in while you were presenting, but I think some of those are very specific for an intro to you because we've seen you guys present and speak. I've heard thousands probably of questions fired at you. I'm going to ask some of the basics that you touched on, but very quickly. I'd like you to talk about the qualifications in order to be able to invest with Greybrook? If you can address that first.
Yeah, sure. So we're regulated by what's called the Ontario Securities Commission. All of these commissions across Canada, actually in the US as well. Basically, they're the sort of regulatory body that governs financial services. And so all of our investors need to be qualified as either accredited investors. Qualified is the wrong word. They need to be accredited or eligible investors. So in order to invest, there's certain minimum financial thresholds that people would need to meet. I can run through the minimums very quickly, which is 75,000 in income as an individual or 125 combined as with a spouse, and a minimum of 250,000 in financial assets, which actually doesn't include real estate. So how these rules are set up in some ways not penalizes, but when you have a big real estate holdings, it in some ways affects you in a negative way, which is not to say it's not a good thing. I think it's a great thing, but at least 250,000 in financial assets. So that would be stocks, bonds, cash, mutual funds, or anything that's invested outside of real estate effectively. And if you meet those, then you're eligible, deeming suitability, which is other things like age, risk tolerance, and stuff like this. You could then make a minimum $25,000 investment.
Perfect. Awesome. The next you touched on, the second question I had is, can you speak to the risk associated with a project like this? And I've heard Peter and Sasha both, address that question very, professionally. And I'd love you to just talk about, because that's a great question for those that are considering investing, whether it be in this project or another future project with you guys. Talk to us a little bit about the risk.
Sure. Yeah. So, it's not without risk. Historically, we have not lost an investor dollar. But some of our projects aren't going quite to what we projected. Probably a handful of or less of projects over the 80. Most have been the upside, but most people care, and so do we. But what's my downside? Like what do I have to lose? And so the biggest risk in any of these things is ultimately your timeline, right? So we've allocated 2 years to take it through sort of a planning process. And that planning process, we've done it many times before. We know the local councilors, we know what we're getting into, but you just don't know, right? Like in this, you don't know with 100% certainty. And so if the planning process shifts a year, now your development may shift a year, and all of a sudden a 6.5-year project turns into an 8-year project. Do we think that will happen? No, but that's a real risk that someone needs to be comfortable with. And that may or may not erode the total return. So that's for sure the biggest risk. Like, for example, not to sort of blabber on, is that when B20 hit, we had 25 low-rise projects or more. And all of those projects got impacted from a timeline perspective. So that's been and now sales are great and it's selling better than we expected. So, I think we'll make up for a lot of that lost time, but that's something that we could have never foreseen. We knew that the government wanted to implement something, but now they implement something that literally stops a market. And so these are risks that we have to navigate. We feel like, how do you mitigate it? You buy well, you don't over leverage, and you have the ability to withstand something like this. And historically, we have a great track record of doing it, but it's not to say that in the future things might be different, right? So I would say that is by far your biggest risk.
Time. That's excellent. That's great. I'm sure there are a bunch of other questions that we're going to handle as individually. As I wrap up, I'm going to hand it over to Spencer for a moment. As I wrap up, I'm going to talk about how to put people in touch with you. I think one of the greatest offerings that you guys make is, and when it comes to investing in any type of real estate, timing is always right. So this is a fantastic project, blue chip location, blue chip developer.
It really is.
But for some of us, it might not be the right time. I'm going to encourage everybody to still reach out and build that relationship with you, because you guys always do offerings. So I'll finish up with that, but I just wanted to hear you get your head nod on that, the intro is one of the most important things, because you guys communicate, frequently as the project takes place. Your communications are not only, well thought out and put together, frequent, but very professional. So on that note, I'm going to thank you for everything that was
Thank you. Thank you, team, too. Thanks.
I'm going to hand things over to Spencer here for a moment, And Darcy, we're going to put you in touch with everyone. Thanks for your time.
Awesome. Thanks. Appreciate it, guys.
Thank you, Darcy. Thank you, Mike. We are now going to hand things over to a very wonderful, unique individual, Andre Matos. He is not only a client of ours, he's one of our strategic partners as a mortgage broker with Scotiabank. And more importantly, as we mentioned before, he's one of our friends. Andre is a very active real estate investor, and he's agreed to share a few minutes with us about his experiences with Greybrook Realty Partners and also some of his real estate investing philosophy. So Andre, take it away.
Thank you for the presentation. Thank you. It's a pleasure to be here. I have been investing heavily in real estate investment since 2016, both passive and active. So both ways, both scenarios. And most of my investors are with Greybrook and passive. I have 6 projects so far. The first one is coming at the end of this year. I'm very excited with Mississauga project. Looking forward for that one, looking forward for other investments. The way I invest and why I choose Greybrook is the structure of the project, the presentation, all the key information is presented to us in an easy way to understand the project. And also the location of those projects. We have projects I invested here in Canada, in Toronto area, North Toronto, and also in south of the border in Florida. Have 2 or 3 projects there, which is nice to have diversification of location. I like the way that Darcy mentioned, the reports we get twice a year. Okay, it's really nice to see the development of the projects going on. So you're investing and you see the investment growing. And the way that I do those investments is diversify. So instead of putting all the money in one project, I diversify in a couple of projects. I like the idea of minimum of 25,000. Sometimes I put more of that. I like the ability to invest RSPs, TFSAs, Lira. It's a good way because we don't need the money now and we can invest for a long term. Okay, so those are very key points that I like to invest with Greybrook. Okay. Any other question?
The reason that's awesome, Andre, and part of the reason we want to bring you is there's no tie. You've experienced, the level of professionalism that Greybrook brings to the table. I know you've been investing with them for some time, and I just think, it was nice to have you even just for a moment speak to the quality and level of professionalism. So I think what I'd like to do is if anybody does have any questions, and I certainly don't want to breach any privacy governance, but if anybody does have any questions and you're happy to, share, this is a very unusual mode of investing, as Darcy talked about at the beginning. To be able to partner with developers is, was a new world to me when I first heard and met Greybrook. And really that's why we want to bring this to our clients, because we take a consultant's approach in advising in real estate. So sure, we only get paid if we buy or sell homes, but because we are so active in the investment component, this isn't the right, this type of investment isn't for everybody. And I would say that whether you're looking at lending on a mortgage or investing in a bricks and mortar property, it's a very passive way to invest with a small equity investment. Darcy mentioned minimum $25,000. So it's nice to be able to diversify across a number of projects where if you call myself or the team, and even if we're looking at an entry-level duplex, your barrier to entry, you're talking over $100,000, equity investment to close on something. So I like to always say this, it may not be right for everybody, but it's an amazing opportunity. We want to thank both Andre and Darcy again for joining us. I'm going to just pull up my screen here for a moment as we kind of wrap up. I want to be respectful of everybody's time this morning. So over the years, I like to show this slide. Over the years, you're going to find reasons not to invest your money in the 30s, late 20s, 30s. It was a Great Depression, followed by the Korean War. When JFK was assassinated, that was a reason not to invest. In the 70s, as oil prices skyrocketed, or in 99 when Y2K was about to hit us, there will always be a reason not to take action and not to invest. And I know this audience and many of the other audiences that we work with, are action takers. It's part of the reason that we love doing business with you guys and just helping educate you. So You'll always find a point in time as to why not to take action. And I'm going to follow that up with, what do we do next? How do we take action? We're going to email everybody a couple of things, a repeat of that presentation. Once we make the introduction or an introduction to Greybrook and one of their advisors, Darcy's going to give the offering package, which you can review. He went through very quickly. Darcy, do you want to touch on any of that quickly as I'm talking about it?
Sure. Yeah. Like, people reach out via that email, invest@greybrook.com. Happy to send materials. So I could do two things. One, I could just send a follow-up email with some of the links and things and thoughts. And then if anyone's interested in the specific project, I'm happy to send that out as well.
Okay. I think what we'd like to do, everyone, we're going to make it really simple and put everything in one email as a follow-up. We're going to give you the recording again so you can review, because there's a lot of unusual content provided. This link is it's a bit link, it's shortened. We will email it to you. If you just register on our website here, for the Greybrook introduction, Darcy and his team have access to that in the back end in real time. So they're going to book those one-on-one consultations with you. So we're going to try and make things really, really simple for everyone that wants more information. And again, like I said earlier, maybe this isn't the right opportunity. Maybe it's not the right time for you. I don't know when we're going to be fortunate enough to have Greybrook in front of our audience again. So I would strongly, strongly encourage at least an introduction so that you can be on these guys' newsletters and informed of what they've got up and coming. Okay, so that's the first thing. As always, I'm going to share, for those of you that don't receive our deal of the week, when it comes to properties in our region that we specialize in, duplexes, triplexes, income producing properties, we try to put this to you on a silver platter every single week. So if you want to register at www.dotw.ca, dealoftheweek.ca, we're happy to get you on that subscription. It's a free subscription. And the teams worked very hard early in the year to put together our biannual investor report. This has tons of great information for the Hamilton region: vacancy rates, rental rates, average price in neighborhoods. It's a great free piece of literature. If you don't have it already, we're going to send you a link to everything and make life really easy for everybody. So in wrap up, I want to thank everybody for their time Thursday morning. For those of you that couldn't attend, we are going to put this out in an email. And I hope you continue to see all of the value that we strive to deliver to our client base. So again, Darcy, thank you for joining us. Andre, thank you for joining us. And thank you all for making it out this morning.